The closing happened on a Thursday. Everything looked right. The inspection was clean, the price was fair, the neighborhood was quiet. 3 months later, a letter arrived from the HOA board. Not a welcome packet, not a newsletter, a bill. A special assessment for $18,000, due within 60 days, covering emergency repairs to a roof the reserve fund couldn't touch because the reserve fund was nearly empty. The buyer had reviewed the HOA documents, pet policy, parking restrictions, guest guidelines, rental rules, all checked. But the rules were never the problem. The financial statements were. Nobody ever thought to ask. Most people buying into an HOA community spend their due diligence time in the wrong documents. They read the CC&Rs, that's the covenants, conditions, and restrictions document that tells you what color you can paint your front door and whether you're allowed to park a boat in the driveway. They check the monthly fee. They confirm whether the community is pet-friendly, and they walk away believing they've done their homework. What they've actually done is read the marketing layer. The rules tell you about the lifestyle. The financial statements tell you about your net worth. There's a version of HOA living that genuinely makes sense. You pay monthly dues, someone else maintains the exterior, the common areas stay presentable, and your home exists inside a structure that tends to protect property values by keeping neighborhood standards consistent. That's the legitimate case for it, and for the right buyer in a well-managed community, it works. But there is another version. A community where the budget is stressed, the reserve is depleted, the assessments are coming, and the legal exposure is sitting in a lawsuit that your lender may or may not approve financing against. That version looks identical from the outside. The listing photograph doesn't distinguish them. The monthly fee might even look lower than average. The 3 red flags I'm going to walk through in this video are not about inconvenient rules. They're not about whether the HOA bans holiday decorations or limits your outdoor furniture choices. They're about financial exposure, the kind that doesn't appear until after you close, when you no longer have any leverage to do anything about it. These are ranked by consequence. The first one is serious. The second one is more expensive. The third one can stop your entire transaction from completing and is the one most buyers never check at all. Every HOA is required to maintain certain financial records, and buyers are generally entitled to request them. The exact timing and scope of what must be provided varies by state, and some states have stronger HOA disclosure laws than others. But in most markets, you can request the documents. The question isn't access, it's knowing which ones to ask for and what you're reading when you get them. The first red flag doesn't look like a problem at first glance because it sits inside what appears to be an internal HOA management report. Most buyers wouldn't think to request it, and it doesn't come up in the listing, but it's one of the clearest early signals of a community in slow financial distress. Red flag 3. A high owner delinquency rate. An HOA's operating budget runs on dues. Every month, every owner in the community is assessed a fee, and that money funds the day-to-day operations, maintaining the grounds, funding the pool, paying the management company, keeping the insurance current, covering the common area utility bills. When a significant percentage of owners stop paying those dues, the entire operating structure starts to compress. You can request the HOA's Accounts Receivable Aging Report. Most buyers have never heard of that document. What it shows is how many owners are current on their dues versus how many are 30 days behind, 60 days behind, 90 days behind, or further. When a community is running at 15 or 20% delinquency or higher, that's not a collection problem. That's a community in financial stress. Here's why it matters beyond the obvious budget shortfall. Owners who can no longer afford their HOA dues are often owners who are also struggling with their mortgage payments. High delinquency in an HOA community can be an early indicator of coming foreclosures. And foreclosures drag down comparable sales for every owner in that community, including you. You haven't bought yet, but you're looking at a neighborhood where property values may be under pressure from inside. The HOA itself responds to the revenue shortfall in one of 2 ways, and both are bad. Either the board begins cutting services to match what's actually coming in, meaning deferred maintenance on roofs, elevators, hallways, and pool systems, Or the board draws down the reserve fund to cover operating expenses, which depletes the account that's supposed to handle major capital replacements. Either response weakens the community's financial footing. This is also where the cost starts heading toward you directly. Communities with stretched operating budgets eventually have to close the gap. That usually means a dues increase, sometimes shortly after you close, sometimes within the first year of ownership. You purchased with a certain monthly payment in mind. The HOA fee was a known number. The new fee schedule wasn't part of that calculation, and it's almost never reflected in the listing. Your total monthly housing cost was lower on paper than it will be in practice. And the difference wasn't disclosed because nobody ran the delinquency numbers before the listing went live. What to ask for. Request the current accounts receivable aging report, the last 12 months of financial statements, and the board meeting minutes from the same period. In the minutes, you'll often see the delinquency discussed directly. Boards typically address it as a line item when it's a real problem. If the minutes don't mention it, but the financial statements show a consistent gap between projected dues revenue and actual collections, you're looking at the same issue from a different angle. A delinquency problem is visible in the financial statements if you know to ask. The next red flag may not appear in any document you receive without a very specific request, and it represents a larger number, potentially by an order of magnitude. Here's the larger principle, and it matters for everything that follows. The monthly HOA fee in a listing isn't a fixed cost. Most buyers treat it the way they treat a utility bill, a known quantity, stable, predictable. It isn't. It's a floor. It's what the HOA is currently charging, not necessarily what the community actually needs to sustain itself. When I look at a community with aging infrastructure and a monthly fee that seems unusually low, I don't see efficient management. I see a bill that hasn't been sent yet. The deferred cost is real. The only question is whether you'll own a unit when it finally arrives. The next red flag is exactly what that deferred cost looks like when it does arrive, and it has a specific meme. Red flag 2, special assessment history and reserve fund underfunding. A special assessment is a one-time charge levied against all unit owners in an HOA community when the association needs funds it doesn't have. It's not a dues increase. A dues increase changes the monthly amount going forward. A special assessment is a separate bill, separate from your regular dues, issued when the reserve fund can't cover a capital repair or replacement that can no longer wait. The triggers are typically large: roof replacement, elevator overhaul, pool resurfacing, major structural repair, parking structure rehabilitation, or sometimes legal costs from ongoing litigation. These are not small numbers. A $500 assessment is manageable for most buyers. A $5,000 assessment is uncomfortable but survivable. A $15,000 or $30,000 assessment is a financial event, particularly when it arrives with a 30 to 60-day payment window and no installment option. Some communities do allow assessments to be paid in installments over several months. Others require full payment within a defined period. The governing documents and the board's resolution at the time of the assessment determine which applies. If you haven't read the financial documents before closing, you may be reading that resolution for the first time after you own the unit. What makes assessment history important is its predictive value. A community that has issued a major special assessment once is a community that has demonstrated it does not maintain adequate reserves for major capital events. The same underlying condition, underfunded reserves, deferred maintenance, aging infrastructure, that produced the last assessment often produces the next one. When I see an assessment in a history, the first question I ask is what changed since then, not what caused it. What changed in the financial management that would prevent it from happening again? Ask the HOA or its management company directly. Has this community levied a special assessment in the last 5 to 7 years? Is any assessment currently pending or under discussion by the board? A board can vote to authorize an assessment without it appearing anywhere in the marketing materials or the standard disclosure package. It may exist only in recent meeting minutes. The reserve fund is the other half of this red flag, and it's arguably the more important number. Every HOA should maintain a reserve fund, a dedicated account for capital replacements. The roof doesn't last forever. The pool deck doesn't last forever. The elevators, the parking lot, the fencing, the common area HVAC systems, none of it does. A properly managed HOA commissions a reserve study, typically every 3 to 5 years, from a professional who inventories all of the community's major physical assets, projects their remaining useful life, and calculates how much the HOA should have set aside at any given point to fund future replacements without issuing emergency assessments. The reserve study produces a recommended reserve balance. The current reserve fund balance is the actual amount the HOA has saved. The gap between those two numbers is what you need to evaluate. A reserve fund at 70% of the recommended level is a warning worth noting. The low 50% is a significant red flag. These aren't universal legal thresholds. They vary by lender, by state, and by the type of community. But the principle holds regardless of the specific cutoff. A community that is substantially underfunded relative to its own reserve study projections is a community that has been living beyond its financial means, and future owners will pay for that gap through higher dues, special assessments, or both. The buyer isn't just purchasing the unit, they're buying into the community's accumulated financial backlog. Lenders understand this. FHA and VA financing programs have warrantability requirements that include HOA financial health as a component. Certain private lenders apply their own thresholds. If a community is significantly underfunded, a buyer attempting to use government-backed financing may discover that the community doesn't qualify, not because of the unit itself, but because of the association's balance sheet. That problem can surface late in a transaction, after inspection, after appraisal, in the final days before the closing date. What to ask for? The most recent reserve study, the current reserve fund balance, any board communication about upcoming major capital expenditures, special assessment history for the last 7 to 10 years, and confirmation of whether any assessment has been authorized but not yet collected. That last item matters. A board can vote to assess the community and give current owners a deadline to pay, meaning a new buyer could be closing into an obligation that's already been created. If you're currently under contract on a property in an HOA community, this is the point in the video where I'd ask you to save it before your inspection contingency expires. Share it with anyone you know who's evaluating a condo, townhome, or planned community right now, because the final red flag, the one I haven't reached yet, is the one that doesn't just cost money. It can end the transaction entirely. Financial problems are difficult, special assessments are painful, an underfunded reserve is a liability, but money problems, in most cases, are eventually solvable. You can price them into a negotiation. You can request a seller concession to offset a known assessment. You can factor higher projected dues into your monthly cost analysis and decide whether the property still makes sense at that number. The final red flag doesn't work that way. When an HOA is involved in active litigation, you are not simply buying a unit with financial exposure. You are buying into a legal proceeding with an unknown outcome, and a significant number of lenders, when they discover that proceeding, will not fund a loan, regardless of the buyer's income, credit, or down payment. Red flag 1. Pending HOA litigation and the warrantability problem. An HOA becomes a party to a lawsuit in 3 different scenarios, and each one carries different implications. The most common scenario in newer developments is the HOA suing a developer or contractor over construction defects. Water intrusion, structural issues, defective materials, code violations discovered after the warranty period. These cases are not rare in communities built quickly during periods of high demand. When you hear about this type of lawsuit, the initial reaction is often positive. The HOA is fighting for the owners. They're pursuing accountability from the builder. That may be true. But here's what that litigation also means. The outcome is legally and financially unresolved. The community may eventually receive a settlement that funds needed repairs. That process may also take years, with attorney fees drawing from the reserve fund or operating budget in the meantime, with no guarantee of recovery. The second scenario is an HOA being sued by one of its own owners. This happens in enforcement disputes. An owner who believes the board applied the rules selectively, a discrimination claim, a dispute over an unpaid fee that escalated into litigation. This type of lawsuit signals something specific about the community, a governance problem. A board that has been sued by its own residents may be one that enforces inconsistently, makes decisions without adequate process, or operates in a way that creates repeated conflict. Future buyers will live under the same board. The third scenario is an HOA being sued by a third party, a slip and fall on common property, a negligence claim, a water damage case involving adjacent properties. This type of litigation depends heavily on the HOA's master insurance policy and its coverage limits. If a judgment exceeds those limits, the gap doesn't disappear. It gets filled by a special assessment against every unit owner. Now here is the consequence that most buyers never anticipate, and it's the reason this is red flag 1. When an HOA community is involved in active litigation, on either side, many conventional lenders will declare the community non-warrantable. That term means the property doesn't meet the standards required for a conventional conforming mortgage or a government-backed loan from FHA or VA. Fannie Mae and Freddie Mac both maintain guidelines around HOA litigation that can result in a community being disqualified from their loan programs. When that happens, buyers are typically limited to cash purchases or portfolio loans, loans that individual banks hold on their own balance sheets rather than selling to the secondary market. Portfolio loans come with trade-offs. They often carry higher interest rates. They may require larger down payments. Their terms are set by the individual lender rather than standardized guidelines, which means one bank may offer a workable rate while another declines entirely. The monthly payment difference between a conventional loan and a portfolio loan at the same purchase price can be meaningful. A rate differential of even half a percentage point on a $400,000 purchase changes the monthly payment by roughly $80 to $100, and a larger differential changes it by significantly more. That difference compounds across the life of the loan and changes whether the property makes financial sense at all. But the damage doesn't stop with the buyer making the purchase. It extends to every future sale. When a community is non-warrantable, the pool of eligible buyers shrinks to those who can pay cash or qualify for and accept a higher cost portfolio loan. A smaller buyer pool suppresses what a seller can eventually achieve. You buy into a community with financing limitations, and when it comes time to sell, your buyer faces the same limitations. That's not a temporary inconvenience. That's a structural discount embedded in the asset. The disclosure problem makes this worse. In some states, sellers are required to disclose active HOA litigation as part of the transaction. In others, the obligation falls on the HOA to include that information in the documents it provides upon request. Not something the seller's agent volunteers at the showing, and not something most buyers know to demand before they sign the purchase agreement. A buyer who receives a disclosure package containing a reference to a lawsuit may see the word litigation and not understand what it means for their financing until their lender raises it as a condition. They may get the document on a Tuesday and close on a Friday without ever asking their lender to run a warrantability analysis on the community. The timeline of a real estate transaction doesn't naturally create space for that discovery. You have to make the space yourself early. Ask directly, is the HOA currently a party to any lawsuit, either as plaintiff or defendant? Ask your lender, before you remove your financing contingency, to complete the condo questionnaire or HOA certification and specifically review the litigation status. In most condominium transactions, this questionnaire is a standard part of the lender's process, but the timing matters. You want that review completed early enough that you still have contractual room to respond to what it finds. Request the HOA's current master insurance policy and coverage limits. Request the board meeting minutes from the last 24 months and look for any reference to legal counsel, pending claims, or board-authorized litigation. Boards discuss these things in minutes. They have to, and those minutes are available to buyers who request them. Now consider what happens when all three red flags are present in the same community: high owner delinquency draining the operating budget, an underfunded reserve generating pressure towards special assessments, and active litigation creating financing risk that neither the seller nor the buyer may fully understand until they're weeks into a transaction. Any one of those conditions, standing alone, is workable. A sophisticated buyer with cash, a realistic view of the risk, and the right negotiating position can potentially navigate a single red flag. But a community carrying all three is a layered situation, and most buyers are discovering that layer only after they hold the keys. None of these three red flags appear in the listing price. None appear in the photographs. None appear in the brochure at the open house or in the agent's prepared remarks during the showing. They exist in documents, financial statements, reserve studies, litigation disclosures, meeting minutes that are available but only to buyers who know to ask for them. I want to be clear about something before we get to the practical steps. These red flags are not automatic reasons to walk away from every HOA community. They are reasons to negotiate from accurate information rather than optimistic assumptions. A buyer who discovers a pending special assessment before closing has options: renegotiate the purchase price to reflect the known liability, request a seller concession to cover the assessment, or walk away if the math no longer works. That same buyer, discovering the assessment 3 months after closing, has none of those options. The leverage disappears at the closing table. The same logic applies to the litigation issue. If a community is currently non-warrantable, some buyers, particularly cash buyers or those comfortable with portfolio loan terms, may find the price reflects that discount and decide it still works for their situation. But they need to know the condition exists before they commit to it, not after. The purpose of this video isn't to make buyers afraid of HOA communities. It's to make them better informed at the moment when that information actually changes the outcome. So here is what I would do before removing contingencies on any HOA property. Request the last 12 months of financial statements and confirm that dues collections are actually tracking close to the projected revenue. Request the most recent reserve study and the current reserve fund balance. Then calculate the percentage funded. Request the special assessment history for the past 7 to 10 years and ask directly whether any assessment is currently pending or authorized. Request a written statement from the HOA's management company or board confirming the current litigation status. And ask your lender early, before you've emotionally committed to the property, to complete the condo questionnaire and flag any warrantability concerns. Read the board meeting minutes from the last 12 to 24 months. Boards disclose problems in minutes that never appear anywhere else in the document package. The buyer at the beginning of this video did most things right. Good agent, thorough inspection, reasonable offer. The mistake wasn't carelessness. It was looking in the right place with the wrong checklist. They verified the lifestyle. They never verified the finances. An HOA community can be a strong purchase, maintained exteriors, consistent curb appeal, shared amenity costs, distributed across a pool of owners. There's genuine value in that structure when the community is financially sound. But a community carrying delinquency stress, an underfunded reserve, or active litigation is a different product than the listing price suggests. The monthly fee is what got your attention. The reserve study, the delinquency rate, and the litigation history are what tell you whether the community behind that fee is actually solvent. If you're currently evaluating a property in an HOA community, drop the state in the comments. Disclosure requirements vary significantly. What sellers are obligated to provide in Texas looks different from what's required in California or Florida, and I want to give you accurate context for where you're actually buying. And if you've already been on the receiving end of a surprise assessment or a financing problem tied to HOA status, I want to hear about it. Those stories matter, and they belong in this conversation. The listing showed you the amenities. The financial statements show you the risk. Both documents exist. Only one of them is handed to you automatically.